Hello, investors. Thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about Magnite. Magnite is an ad tech stock that has been severely punished in 2021. So, we're going to talk about that. We're going to talk about its revenue growth rates. We're going to talk about one of the things that investors are quite despondent when it comes to this company, and predominantly it's that it's highly acquisitive, and we're going to talk about its valuation. So, before I jump in, I just wanted to highlight there's so many fears out here about Magnite. So, at first, we had all the idea that this was just like a pump and dump scheme. Then there was the fears about interest rates. Then there was the fears about whether the company was too acquisitive, and then there was the like. There are so many like fears about privacy, etc. Those are known knowns, right? That's well and truly factored into the share price, and there's no real justification for its underlying business to have sold off by nearly 40% in the past several in the last like 8 weeks or so. I mean, the stock has just been absolutely obliterated. When what's more important here is that I already felt that before this had sold off that it was cheap, and now it's just been totally just like washed away. And what's particularly interesting right now is that in tech there are few pockets, not many. I'll be honest and say that there are few pockets that are still really overvalued, and there's the rest of tech that's just been totally just like washed out. And it's quite an interesting time to be invested because this kind of discrepancy between a few key names and the rest of the space is quite interesting. So here's the thing, right? The way that it reports Magnite's revenues, it reports it on a gross metric, on a gross basis. That means that it adds back, which is for GAAP, it adds back traffic acquisition costs that it has no control over. Okay. What it does guide for is its guidance excluding traffic acquisition costs. So you'll see it reported that they're guiding for Q4 to be up 73% year over year, but I've grossed up the figure here for Q4 2021 to 83% because I've just kind of estimated more or less in the ballpark what traffic acquisition costs. It's just my estimate. It's probably going to come out wrong, but anyway, somewhere between let's say 73% year over year growth to 83% year over year growth. And that's clearly very strong growth, right? But the problem is that they made the acquisition of SpotX back in Q2 21. So that's added a substantial amount of inorganic growth rates to the top, okay? But that is already well and truly factored into the share price. Everyone knows about this already, right? And what I think that investors are not really giving enough benefit to the doubt is whether or not Magnite can grow at least 20% compounded annual growth rates over the next couple of years. Now, why is Magnite interesting? Okay, so here's a figure, right? On the left side, you got the likes of the trade desk. These are DSPs, and what it does, the trade desk, is connects brands to an exchange. Brands or advertising agencies that want to put out an advert, they do so to an exchange. So it's a very interesting business model. On the other side, on the right, are supply side platforms. Supply side platforms essentially give companies, for example, Roku, a way to monetize their ad space, whether it's on a screen, on desktop, mobile, whatever. That ability to monetize their ad space in a conflict-free manner is what really drives these kind of platforms, such as Magnite, to grow their business model. Because often cases you don't want, like if you're a broker, you don't want to be necessarily just reliant on the likes of Alphabet or Google to monetize your ad. You might because you're in conflict with them. You're trying to get YouTube to kind of be on your platform. You don't want that. So you may have some exposure to that, but you don't want to be solely reliant on that. So this is just one example. And what I think is quite interesting here is that it's the idea that everything is already like so much driven towards everyone is very much driven towards Magnite not being able to grow the revenues any further because it carries a substantial amount of leverage. So you can see here. So it's going to exit 2021 with a bit more than 3.5 times net debt to EBITDA. So you don't want that. If you're in ad tech space, it's like very volatile. You saw back in Q2 2020 how when advertising revenues just implode, it's a volatile space, advertising. You look at, let's say, the likes of, let's say, Alphabet or Facebook, those businesses have very little, or absolutely, in the case of Facebook, has no debt on its balance sheet. So you don't want to be leveraged 3.5 times. I mean, this is really precarious. And so that fact, is kind of investors are like, okay, if I pay down your debt. So when Magnite announced they're going to repurchase 50 million worth of their stock, investors are like, well, that's nothing. But what it should tell people is that Magnite's motivation to make more needle moving acquisitions is gone. Okay, they're paying down their debt, they're making a few share repurchases. Share repurchases are pointless, it's just a story to tell you that essentially they have enough cash. And okay, you could have said, okay, you could have just paid down that debt, and that's a valid argument. But 50 million is not a big deal here, really. But the point that they're not going to be making any more meaningful acquisitions, I think that's something that's quite interesting. Now, Magnite says, okay, at their analyst day a few weeks back, that their operating cash flows, which is EBITDA minus capex, is going to reach approximately 100 million in 2021. Now, let's think about this logically, right? So Magnite is guiding to grow at approximately 25% compounded annual growth rates. Now, let's just say that they don't grow 25, they actually end up growing 20. Okay, that's if they're making 100 million of cash flows this year, and I checked Q3 21, they made 34 million of free cash flow. So if they're making approximately 100 million of cash flows from operations this year, and it grows by 20% into next year, they'd reach 120 million next year. That puts the stock price at approximately 19 times next year's cash flows from operations. That's pretty cheap for businesses growing at 20% CAGR, I think. And now here's a lot of things that are like the analysts following the stock, they pretty much expect the company to be growing at this rate, so 20-25%. You can see here, even towards the back end of 2022, they're still expecting that kind of approximate 20% CAGR. So analysts expect it. It seems reasonable. Management is guiding people that they're going to be growing at 25%. So 19 times forward cash flows, I think that's quite attractive. It's not forward sales, it's forward cash flows. Now, a few things that I wanted to highlight, right? I mean, I understand that it's been pretty painful for anyone invested in Magnite. I mean, I get that, right? The easiest option is just to clean up your portfolio, start 22 fresh, But I wanted to highlight two things to that, okay? So the first thing is that waiting around to buy the dip is difficult, right? The dip is here, the dip is now, okay? Secondly, everyone kind of leaves cash on the side, and then when they see the share price go lower, they kind of feel vindicated. Oh yeah, I was so smart for not investing. But you don't get a return from having cash inside. You get the return from investing in a company and staying invested. The other thing that I wanted to highlight is that market timing is a fool's errand, right? Because it's the time in the market that gets you the reward. It's not trying to kind of time it in and out. It's just not how it goes. The reality is that there are good periods and the bad periods, and the periods are bumpy. But you kind of it's the staying invested that really makes a difference. Anyway, and lastly, if one is waiting for everything to be really rosy and the outlook to be perfect, at that time it's too late. Okay. Anyway, hope you found this video useful. Don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor. I help you think through investing. I give you high quality, actionable insights. Okay, thank you so much for listening. Bye bye.